Investing basics. Building wealth and creating opportunities for the future. Introduction. If saving helps you prepare for tomorrow, investing helps you create the future you dream of. For young people aged 18 to 35 across the world, investing is not just about making money, it's about building financial security, generating wealth, and empowering communities. Investing is the process of putting your money, time, or effort into something today with the expectation of greater returns tomorrow. While savings keep your money safe, investments help your money grow. As future leaders teaching financial literacy in schools, it is crucial to understand investments yourself before you can simplify these concepts for students in coffee clubs. This module will equip you with the knowledge and confidence to start investing early, explain it to others, and use it as a tool for poverty reduction. 1. Why investing matters. 1.1 Wealth creation. Investing allows money to work for you, multiplying over time through profits, interest, or dividends. 1.2 Beating inflation. If you only save money without investing, inflation, the rise in prices, reduces its value. Investments help protect and grow wealth beyond inflation. 1.3 Achieving long-term goals. Buying land or a house. Funding education. Starting a business. Preparing for retirement. 1.4 Community empowerment. When young people invest in local businesses or projects, they create jobs, build enterprises, and stimulate economic growth. 2. Difference between saving and investing. Saving versus investing. Low risk. Higher risk. Money kept safe. Money grows through returns. Goal, security and emergencies. Goal, wealth creation. Examples, savings account, piggy bank. Examples, stocks, bonds, businesses. Both are important, save first for security, then invest to grow wealth. 3. Types of investments. 3.1 Traditional investments. Stocks, shares. Buying ownership in a company. You earn through dividends or share price increase. Bonds, lending money to governments or corporations, earning fixed interest. Mutual funds, pooling money with other investors, managed by professionals. 3.2 Alternative investments. Real estate, buying land, houses, or property for rental income or resale. Agriculture, investing in farming, livestock, or agribusiness. Small businesses, starting or supporting ventures in your community. 3.3 Modern investments. Digital assets, cryptocurrencies, NFTs, and digital trading platforms, high risk, requires caution. Fintech savings apps, platforms that allow micro-investments globally. 4. Risk and return in investing. 4.1 Understanding risk. High risk equals potential for high return. Low risk equals smaller but safer returns. 4.2 Diversification. Don't put all your eggs in one basket. Spread investments across different areas to reduce risk. 4.3 Example. If you invest $100, $40 in savings for security, $30 in stocks for growth, $20 in a small business project, $10 in a high-risk/high return option. 5. The power of compound interest. Compound interest means you earn interest on both your initial investment and the interest it has already earned. Example. If you invest $500 at 10% per year. Year 1, $500 plus $50 equals $550. Year 2, $550 plus $55 equals $605. Year 3, $605 plus $60.50 equals $665.50. Over 10 years, your money will grow much larger than you expect, all because of compounding. Lesson for young people: the earlier you start investing, the more powerful compounding becomes. 6. Practical investment options for young people globally. 6.1 For beginners. Savings accounts with interest. Government savings bonds. Group savings and investment clubs. 6.2 for growing investors. Mutual funds. Stock market. Real estate crowdfunding, small contributions to property projects. 6.3 for entrepreneurs. Starting a micro-business. Investing in agricultural cooperatives. Supporting peer-to-peer lending. 7. How to start investing as a young person. Step 1. Educate yourself. Read books, attend workshops, and use reliable apps. Never invest in something you don't understand. Step 2. Start small. Even $5 or $10 can be invested through digital platforms. Consistency matters more than amount. Step 3. Define goals. Ask, why am I investing? For education, business, travel, or long-term security? Step 4. Choose safe platforms. Research before using apps or online opportunities. Avoid scams promising get-rich-quick returns. Step 5. Monitor and adjust. Review investments regularly. Shift strategies as your income and knowledge grow. 8. Teaching investing basics in schools, coffee clubs. As a leader, you must simplify investment concepts for students. 8.1 Use simple analogies. Tree planting analogy. Investing is like planting a tree. You don't eat the fruit immediately, you wait and nurture it, and later it gives you food for many years. Piggy bank versus cow analogy. Saving is like keeping coins in a piggy bank, but investing is like buying a cow that produces milk every day. 8.2 Practical activities. Mock stock market game. Students invest fake money in companies and track growth. Savings to investment challenge. Students save small amounts and simulate putting them into mini projects. Investment stories. Share real-life examples of young entrepreneurs who started small. 8.3 Tools for teaching. Visual charts showing growth through compounding. Board games that simulate business or investments. Short videos about successful investors from different regions. 9. Case studies of young investors globally. Case 1. Youth in Kenya. A group of university students formed an investment club, pooling $2 each week. In 1 year, they bought chickens, sold eggs, and reinvested profits. Today, they run a poultry business that supports their education. Case 2. Young professional in India. A 24-year-old started with mutual funds through a digital app. By investing small amounts monthly, she grew her portfolio to over $10,000 in 5 years. Case 3. Tech-savvy youth in Nigeria. A young graduate invested in agricultural crowdfunding platforms, funding farmers with small contributions. Within 2 years, he earned profits and also contributed to food security in his community. 10. Common mistakes to avoid in investing. Starting too late. The earlier you start, the more compound interest works for you. Investing without research. Avoid scams and fake opportunities. Chasing quick money. High returns in a short time usually mean high risk. Not diversifying. Putting all your money in one place is risky. Ignoring small amounts. Even $1 invested regularly grows over time. 11. Building a culture of investment among young leaders. As coffee club ambassadors, you must encourage students to save first, then invest. Think long-term, not short-term. See investments as tools for community growth, not just personal wealth. Pass knowledge forward. Every student can teach their family or peers. 12. Role of young leaders in promoting investment education. In schools, teach students to dream big and use investments as tools for achieving those dreams. In communities, organize seminars and workshops for parents and youth. Globally, use digital platforms to share stories, lessons, and tips on investing. By teaching investing basics, you're not only helping others secure their future, you're also contributing to global poverty reduction. Conclusion. Investing Basics is one of the most transformative modules in the financial literacy journey. For young people aged 18 to 35, investing is not just about money, it's about building a sustainable career, empowering communities, and shaping the next generation. Remember, start small, start early. Be patient and consistent. Teach others the importance of investing. As Coffee Hub leaders, you are more than investors, you are builders of hope, creators of opportunities, and ambassadors of financial freedom. By mastering this module and teaching it in schools, you will inspire students to dream beyond limitations and build wealth that benefits not just themselves, but their families, communities, and nations.